and welcome to Money Talk. I'm Kim Parley. It is great to have you with us tonight. Earnings. Companies have been putting up very strong headline beats this quarter. So why haven't we seen a more significant pickup in the stock prices? Joining us tonight is Ben Gossack. He is portfolio manager at TD Asset Management to talk about, to deconstruct those earnings we've been seeing and tell us what it might mean for the markets. Always nice to have you here.
Thanks for having me back.
Let's start off with some of the numbers. I think we're about 90% through the earnings season so far. And you're going to show us some charts showing these are pretty awesome earnings, actually. I mean, not to exaggerate, but they're very strong.
This is amazing earnings.
Yeah.
And we're getting it from the top line. We're getting margin expansion. We have a benefit of taxes for the first time coming through this quarter, and we're having monster earning numbers.
Where's the love in the stock market?
Yes, I think that's, if you beat on your top line, you beat on your bottom line, you raise estimates, you're getting a little bit of love from the market. But this is a nervous market, and we can walk through those issues. But we're seeing broad-based beats across every sector.
Let's, any standouts for you in terms of, the numbers? I think you were ahead of expectations by about 8%. Is that?
Yeah, so companies, if we were expecting earnings to grow about 18%, earnings are growing 25%, so we're getting almost 8% beats. And this is coming
on
across
a very
the board.
high bar to begin with.
I mean, energy, financials, technology, we're supposed to deliver a lot of our growth, and those are the sectors that are delivering. But just about every sector is putting up good numbers. You
brought a chart in here, which is, I think, a bit jaw-dropping. So is the next one we're going to show. But this is revenue growth on the S&P 500. We've got it. It's on a quarterly basis. If we bring it up, I believe we have the yellow chart here on the right is showing the revenue growth year over year. And again, you're lapping some good numbers to begin with.
Yeah, I think, if you look at, we have 8% growth this quarter, you could compare that to Q4 and say that's not a lot, but we're growing 8% on a quarter where we grew 6% the year before. A lot of times companies have a great quarter and that becomes a headwind for them. We're beating that headwind for the whole sector, for the whole market.
This next chart is even better. So let's bring up the next one. This is earnings per share growth. That's jaw-dropping.
Right, so let's spend some time on it. We're getting 25% earnings per share growth for the quarter. If you look across the whole chart and we go back to 2012, it stands out. And it also stands out on a comparison of 15%. As we said, this is the first quarter where we start to see the benefit of taking the corporate tax rate from 35% to 21%. So of that 25, about 7% is from the benefit of lower taxes. But even adjusted for that, 18% earnings per share growth on a comp of 15 is pretty amazing. And again, it's not just because companies are buying back a lot of stock. It's not just because we're getting margin expansion. We're getting nominal GDP growth around 5%. Companies doing a little bit better than the economy. So that 8% dropping down to the bottom line, that's really fundamental. And for a lot of companies, they took up their guidance for the full year.
What's the disconnect then? Why? You're showing me all these charts, and again, I can see the excitement when you're talking.
Yeah.
This is, these are giddy numbers, and yet we're not seeing a big reaction in the market.
Yeah. So typically, you should get that positive pop, and the reason why things have been negative, and even just commentary from management on conference calls can set a stock down 8% in a second. And I think the bigger picture right now that's going on is that we're 10 years into this recovery. And it's been a shallow recovery, so it could continue on for a couple of years. But I think people are feeling that it's inevitable. Every day that goes by is one day closer to this recession. Mm-hmm. And so people have this marker. Is it 2019? Is it 2020? Is it 2021? So as we get data that comes out, if inflation comes a little higher, we'll pull that goalpost a little closer. And if employment still looks good, we'll push it out a bit. So there's a lot of questions, are we at peak earnings? Are we at peak margins? Is the recession around the corner? And if it is, then people would want to sell.
Are we? Are we? That's the question then. So what's the answer?
So I think we have to go back to the data.
Yeah.
And the data remains robust. And for us, that's what matters, because if the data is up and the economy is expanding, mm-hmm. that continues to fuel that earnings growth. So we're tracking 20% earnings growth for the S&P 500 for the full year. We can't do that again next year. A lot of that's driven by the taxes, so we'll lap that. But again, if we're putting up 6-7% earnings per share growth, that should continue to support the stock prices.
Let me ask you about some specific sectors. I mean, do you have any, given what we've seen so far, do you expect we're going to see outperformance in any specific sectors in the second half of the year?
Yeah, so the same reasons why we've loved technology, all those secular themes, whether it be mobile, internet, social media, cloud, that continues, and we should expect technology to continue to deliver. Energy. We forget, now that we see oil at 70, we forget that we came from $26. So we were about $50 oil last year for this quarter, and we were basically average about 60. Some people will forget that in the summer, we were almost down to 40. So we can continue to lap those low oil prices all the way into 2019. So energy will be another big driver for the rest of the year. And the same thing for the banks. They benefit a lot from the tax reform, and they also can return a lot of capital. So they'll also continue to be a big driver for this market.
I know you said, you like, I mean, there's been a lot of good being talked about in here. Management discussion, you said, is an interesting one. Do you feel it's a little more influential than it has in earnings calls past? Because I think, I seem to remember this, Caterpillar, I think, came out, decent numbers all around, and then, of course, when the management commentary came out, the stock tanked.
Right, so amazing numbers for Caterpillar, also benefiting from global synchronized growth.
Yeah.
So they beat numbers at the top and the bottom, they raised guidance, and then management on the call said that this could be the high water mark for the year. That was interpreted that this was as good as it's going to get, and if it's as good as it's going to get, then yes, the stock might have been up 4%, closed at 6%, and not only did it take down CAT, it took every industrial company with it. So really blue chip companies like 3M, Honeywell, United Technologies all came down from that. So I mean, industrials looks like an area where got oversold, could be an opportunity to sort of spring back.
I want to spring in one last chart. We've only got about 30 seconds here. We've got to look at the PE ratios on the S&P 500, and we see this is a decade or multi-decade long chart we're looking at right here. But when you take a look at 2000s, you can see where we were and where we've come down here in the past little while. Do you think is there opportunity to get back up again, or is this the concern?
So a lot of chatter last year about, oh my gosh, this market is so expensive. We're at 18.5 times. That's where we peaked at the end of the year. We've talked a lot about the fact that $1 of earnings today is not the same dollar that you got 10 years ago, 20 years ago. So 50 cents of every S&P dollar is coming from capital-light businesses, whether it's healthcare, technology, Amazon, Netflix. Those are businesses with better income streams that we can
more
see.
capital efficient.
And we will pay a higher multiple. So we're not mean reverting back to old averages. So in essence, we should be at a higher multiple. Having said that, because there's been volatility and some uncertainty, being at 16 times this year's 15 times earnings next year does make equities compelling. And also relative to bonds, it also looks very compelling as well.
All right, stay with us when we come back. We're going to have more with Ben. We're going to delve into banks.